What the? I'm your host, Steve Van Metre, and thanks for joining me today. In our show today, government deception is revealed. The data was all fake. And I want you to understand this has serious implications, and not just for consumers and businesses and investors, but for the policymakers of this country who make policy based on inaccurate and deliberately false data. And what this means is we're about to see policymakers send this country into a deep recession, and it has everything to do with the fact the data was wrong. Now, let's head over to California as we see now the newest early jobs revision shows no net job growth during 2023. And this is coming at a time when we saw that there was massive job increases out of the Golden State. And we were supposed to believe that their economy was booming as we knew that businesses were leaving and other people were moving out of the state. And now we're finding out the truth is far worse than the political elites want us to believe, because the monthly state job estimates are revised annually, and each month their office publishes the most recent state employment figures based on the current employment statistics survey. State employment figures come from this monthly survey, which is based on a small sample of businesses in the state. And as a result, once per year, the Bureau of Labor Statistics does a revision updating the monthly CS estimates to match more reliable administrative data. And now we're seeing this is changing as federal researchers are now publishing quarterly revisions, and what they're finding out is there's massive discrepancies. And the problem here is you see investors and businesses and market makers and political elites base decisions of policy on this data. And now, of course, when you go back a year, well, no one really cares that much because they're only fixated on the current data. Now what we're finding out is with quarterly revisions, things are far worse. And here we can see that the researchers at the Federal Reserve Bank of Philadelphia begin publishing state-level early revisions based on the same underlying data, but revised far more frequently. And look at this. They suggest that the state of California lost jobs during the fourth quarter of last year. And based on the most recent release of early benchmark, payroll jobs declined by 32,000 from September through December 2023. On the contrary, the preliminary monthly report showed a solid increase of job growth with huge discrepancy of plus 117,000 jobs created at the time. With the fourth quarter revision, calendar year 2023 saw essentially no net job growth, only mere 9,000. As data released since January 2024 has yet to be rebenched, but what we can assume it is likely to be rebenched down. And we talked about, when we look at the head non-farm payroll report of why these are so critical, that the data seems very inaccurate. And it used to be a whole lot better, but lately what are we seeing? Massive revisions, numbers that just don't add up. And now we can look to California and the Philly Fed, where we're starting to get answers that the government is deliberately putting out false data. And here you can see the discrepancy is huge. This is what the number of state of California said way up here. The actual number much lower. And if you're looking for a chart that makes sense, how about oil? Here's from today. Oil prices push higher as demand expectations offset dollar strength. That means that oil is up today. And if you're wondering if you could have been making money on this, you could have. In fact, we alerted our subscribers back on 6/11 when our CTA timer pro that looks at the machine positioning on a historical basis noted the machines were short and price was rallying, but I didn't like it. I told my subscribers, here you can see, I'd pass on this. But the next day it triggered again. I gave our subscribers why. I said now was the time to enter this trade. My conviction was low the day before, but it changed. I gave them the upside target, which has been broken. Stop loss levels and everything as of Friday. They're up 2.37%, and today oil is rallying even more, and you can start making money trading in a big way. There's links in the description below. You get a 30-day free trial. Why do we give you 30 days? Because when we give you the data, I give you my input, I tell you how to trade it, and we stay on top top of it so you can make money. We're that confident in what we offer, but the state of California isn't, because, well, theirs get revised, and the data since January 2024 has not been rebenched, which means that the figure includes the early benchmark revision for these recent months are growing at the same rate as the official CS estimates. But one can absolutely certain that once the next set of revisions come in, California will not generate any actual job growth for the second year in a row. And perhaps, as Zero Hedge knows, this may be for all of America, because this is the problem. We hear about the Federal Reserve and they make policy. We told by them that it has something to do with inflation, but it really has a lot to do with the labor market. And one thing Wall Street and the Fed really focuses on is the monthly non-farm payroll report. And back over time, it used to be far more accurate than it is now. Things have changed about how they handle this, and it's gotten inaccurate. I want you to see, as we look at what the economy should be experiencing, is we look at the non-farm pay report, and I've cut out everything from the pandemic on just so you can see the relationship between retail sales. And what did we know happened with retail sales recently? They went down. In fact, they're really about a 0% year-over-year change. What are we hearing from retailers? As demand's going down, we're hearing that people cannot afford current prices, even value meals at McDonald's that consumers can't afford. And when that happens, businesses start to lay off people. And here's the relationship. You look at the non-farm payroll report, we're seeing here change in thousands of persons in blue. And the reason I cut the pandemic off as well, the chart gets completely unreadable against advanced retail sales, this shown in red, on a year-over-year rate of change. And so we've noted that retail sales have been coming down in a big way post-pandemic, and that means, of course, payrolls should be coming down as well. But there's just this odd problem. Is they're not coming down? And it becomes very clear now that based on fake data, we get fake numbers, and then you get bad policy and bad decisions. And even investors get in on this, because you look at what happens with markets when you start to see the economy slow down and you see payroll start to decline. Looking at the NASDAQ 100 now, you can see that peaks in the market are not far off from where payrolls start to turn down and eventually head negative. But right now, if we had real actual data, well, it would suggest that the payroll market in terms of labor is far worse than the actual printed numbers is displaying, which means investors are betting on a big rebound in the economy when the actual data says is highly unlikely. And then we turn to the Fed, who makes policy in the same fashion. We talk about inaccurate data. You know, the Fed believes that the labor market is strong and robust, and they need to keep interest rates elevated. But look at the relationship here between the non-farm pay report, again, still in change of thousands of persons, against the federal funds rate. And you go back through history and you can see decelerations in the job market that turn into contractions when they're underneath that horizontal black line. Well, that gets the Fed's attention and the Fed starts to cut rates. And you can see this relationship over time. The only time you're not seeing it is right now, because we continue to get these payroll reports that look better than they actually are. And the problem is with these annual revisions, it's so far back in the past that no one really is concerned about it, because they're fixated on the current fake data. What I want to know is, are you outraged by this? What's your opinion? Weigh in the comments below, because now let's head over to Texas. We started with California, but you can see what happens when we have policymakers that make monetary policy so tight that we constrict the creation of credit. You start to send the economy into an abyss. As we see Texas manufacturing activity stabilizes in June, which was a pretty generous statement. As Texas factory activity, while it was flat, according to business executives, the production index inched up to 0.7 from minus 2.8 in May, means there's little change in output. But look at this, new orders index remains slightly negative as demand continues to go down. And though it moved up steadily over the past few months, the capacity utilization index, or what amount of a factory is being utilized, slipped to minus 4.8 to minus 2.0, and that is really an issue as we see demand continue to fall, factory capacity starts to shrink, and what happens is you need fewer and fewer employees. And sure enough, that's exactly what showed up in Texas as labor market measures. And we've been seeing this across all these Fed surveys. We've been seeing it in the PMIs, and we don't see it in the headline government data. And that's really the frustrating issue here, is you have bad data suggesting slight employment declines and shorter work weeks. And it makes perfect sense when your factory is not running at full production, which we see that, and capacity of the factory is shrinking. Well, you shrink the number of hours you're offering your employees, and you get rid of a few employees to maintain the employees that you want to keep. And that should show up in the state unemployment data, should show up in the headline non-farm payroll reports. Instead, we get these lag revisions, and that means bad decisions get made based on that. 17% of firms noted net hiring, 20% noted net layoffs, and hours worked index held fairly steady at -5, meaning workers are getting less hours. That means less money to spend in the economy. And despite that, upward pressure on prices and wages continued. The wage and benefits index edged higher to 24.3, but of course the sacrifice of jobs and fewer hours changes everything. Consumers, of course, workers may get a little bit more money to spend, but not that much. And here, looking at the details you see in paper manufacturing, we're really neutral in our outlook at this time, which is when we're supposed to see the economy rebounding. Remember, there's supposed to be a soft landing or no landing. We're starting to see things slow down in the printing area. How about primary metals? Our overall building and construction sales continue downward for a majority of our customers, and fabricated metal manufacturers are saying we're continuing to align our production capacity, think lower, to the lower order volumes projected in 2024. Again, we're not seeing the second half rebound because the Fed cannot adjust policy because they have bad data, and this is a huge problem. It's not just the Fed that we're seeing this issue at, it's central bankers all over the world. Now let's turn to Germany. We talked about how their manufacturing sector is still in a depression. Look at this. German business expectations fall and setback to rebound in hope. And that's the key, is everybody's basing all their decisions on hope. Yet the central bankers have it right, that they just need a little more evidence to get inflation down, and then they're going to pull back off of their tight policy and the economy is going to roar, but that is not the case at all. Here we see an expectations gauge by the IFO Institute fell to 89 in June, now rolling over. As you can see here, define analyst predictions for an improvement. The measure of current conditions, though, did hold steady, but outlook is in the decline. And the country's large manufacturing sector firms, quote, are now telling us that the order backlog is a problem. Now, we've talked about order backlogs. This is important because one of the questions that I've been maintaining is, when do the backlogs run out? Because when you have a group of employees at your company and you have work for them, it's not a problem. And so ideally, you have a lot of new orders coming in, and then you have, of course, those you can't get to fall into the backlogs. But new orders have been dropping so much and been contracting so much that, of course, workers are focusing on the backlogs, and they've been going through this for many, many months in a row. And now it's becoming a problem because when the backlogs run out and you don't have enough new orders to sustain your workforce, well, you're not just cutting hours. You're going to cut a lot of heads, and that's the problem here, which is now showing up in Germany. He pointed to bad data from retail, which signaled the expected rebound in consumption on the back of rising wages is just not happening. And that's what the political elites wanted us to believe, that if everybody got more wage increases, that everything would be okay. We said that's not what the issue is. Is wage increases aren't enough. They need more hours because they have too much debt, and the rate they're paying on the debt went up. This is a problem, and now all of a sudden there's no answer. And of course, it's all based on bad data. As subdued foreign demand and high borrowing costs are major obstacles for Germany's manufacturing sector, which has lagged behind the services sector in recent months. The threat of greater trade tensions with China is an additional worry. But while monetary easing by the European Central Bank should help reverse that development, at least that's the fantasy. Do people think, well, if the central bankers just cut maybe 0.25% or 0.5%, they're just going to unleash all this spending? But the average consumer doesn't even know what that means to their budget. They don't even understand what rate cuts actually have an impact? And the reality is they don't. Nobody goes out and says, hey, you know, the Fed's going to cut rates. I think I'll go out and spend. No, they make their decision on their jobs and their outlook. Are they getting the hours they want? Are they getting the wages they want? And can they pay on all of their bills and still have money left over? And right now, consumers are not confident, and for good reason. The government tells them there's all these jobs, but the reality is the market is saying just the opposite. As officials have made it clear, they'll be cautious in lowering borrowing costs. Investors only expect between 1 and 2 further cuts this year. The reality is there's going to be a lot more cuts than that, because once the truth gets out on these payroll reports, we find out the economy is far weaker, the Fed is going to be massively behind the curve. And you kind of wonder, people say, well, don't you think the Fed gets this right? No, they get it wrong because they use bad data. And now it's so bad that by the time the bad data actually tells the Fed they should be cutting, it's going to be way too late. And even China's got problems with Germany as they float perks for German car makers to prevent EV levies. Again, it comes back to the manufacturing sector. We started out, of course, with exodus of California, but the Texas manufacturing sector is shrinking despite the fact that oil prices are rising. And now we're looking at Germany. And what do we see? Manufacturing sector going down despite an increase in wages. And you look to China, who is trying to keep their economy going by exporting and overproducing. It's not working because they know they need to get those vehicles out on the market, because China floated lowering its existing tariffs on large engine cars in return for scrapping planned EV levies on import from the Asian nation. And of course, this means Beijing currently imposes a 15% fee on passenger vehicles from the bloc. They now want to redo this because the possibilities of the advantages to its German counterpart in a meeting in Beijing, one of the people said that the number 2 economy came weeks after the EU proposed hiking charges on electric cars to as high as 48%. If they did that, it has a massive impact on China's labor market, because it means all this demand coming out of the factory, which Beijing is directing, grinds to a halt and people are out of work. You're starting to see the global economy is shrinking, the data is inaccurate, and next thing you know, we're going to be in recession, and the elites are not going to actually believe it. And here you can see the Chinese EV industry received at least $231 billion in government subsidies and aid from 2009 to the end of last year, and they're looking to export that all over the world, and people are saying no. And you start to see why China needs this. Well, look at this. Their fiscal income drops at the quickest pace in more than a year, because that means their economy is contracting. Total revenues, which include the general public budget and government funds budget, fell 4.1% during January to May from last year. That's the steepest drop since February 2023, suggesting China's economy is now in a contraction, and it's only a matter of time before it starts to show up in more data. The U.S. economy headed the same way. The German economy headed the same direction. And you can see the relationship here between government tax receipts and non-farm payroll reports. The reality is the non-farm payroll report used to follow this with some sort of accuracy. Today, not so much. You can see the beautiful relationship between this. As people lose their jobs and go on the unemployment line, well, tax receipts fall. And what you see in China is the same effect, except they're trying to hold up their manufacturing sector. And we say good luck to them, because we needed all that luck we can get, because right now the Fed and other policymakers are making decisions based on fake data, and that's going to send us into a recession far sooner than anybody believes. And with that, I'm Steve Van Metre. Thanks for watching. Thanks for being fans. Bye now.